Hello everybody, Stuart here, and welcome to our very latest webinar. Today we're going to be going through Japanese candlesticks and how to trade them. In the meantime, if you've got any questions or any problems with the webinar today, please email me at webinars@hotforex.com, or obviously pop a question in the question box and I'll endeavour to get back to you as quickly as possible. Okay, so welcome again, and let's crack on so we can get through our allotted time here together. So trading with Japanese candlesticks, on the Japanese candlesticks, very ancient tradition, and very popular with traders around the world. But before we get going, I'd just like to run through our disclaimer, which I need to do a bit of admin before we get going. So this material is provided as a general marketing communication for information purposes only and does not constitute independent investment research. Nothing in this communication contains or should be considered investment advice or an investment recommendation, or indeed a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performances is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in FX and CFD products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. And finally, this communication must not be reproduced or further distributed without our prior written permission. Okay, so welcome again everybody, and that's just our admin bit out of the way. A quick intro on me, if you won't bear with me. That's me. My name's Stuart Cowell. My background is in the City of London. I've worked for investment banks and retail banks. And I first started trading and investing myself back in 1997 when I had the capital and resources to do so, and I really enjoy it. I love it. It's good fun. Over the years, there's my approach, and I could sort of boil it down to these four little phrases here. Do what's probable. Always do what's probable. Keep probability on your side. That way, it keeps it stress-free. Try and keep it as simple as possible. Simplicity, probability, and also always look at multiple time frames. So if you're trading off, you look at your charts once a day, you're trading off daily candles. It's important that you know what's going on in the weekly and the monthly time frames as well. So trading with the trend sometimes is much more comfortable and much more relaxing than trading against the trend. Nothing wrong with trading against the trend, it's just you need to be aware of it, and that's why multiple time frames are so important. And that's the case whether you're, as I say, trading daily candles or down at 5-minute and 1-minute candles. The philosophy of the approach is always the same. But most importantly is that last bullet point there. I would say is to know yourself, because it's all about, for me, it's all about risk management. It's all about knowing yourself. And if you don't know yourself, if you can't accept a loss, you'll never get past first base in this game, because it's it is a bit of a game. And if you approach it that way, it becomes less stress-free, and the success just comes as a part of doing the job. But like with any job, it takes practice and discipline and patience and all those good words as well. Okay, but knowing yourself is really important. So anyway, that's enough about me and my ugly mug. So let's crack on. So today we're going to go through, as I say, Japanese candlesticks. So hopefully at the end of this hour or so you will understand the basics of Japanese candlesticks, where they come from, why they're so popular, and lots of different patterns. A single some people trade just waiting for a single candle to form. That's all I don't, but some people do. So we'll look at those single candle patterns that are important to some traders. Others trade off multiple candle patterns, whether it's 2 or 3 or even more in some cases. So we'll look at those as well, multiple candle patterns, trying to establish some sort of trend as well. Really good for trend trading. And then I'll put it all together at the end. There's 5 key combinations of 5 key things. So there's lots of different words used in Japanese candlesticks, which is very alien to many people in the West. Just getting your head around that sometimes was a bit complicated for me when I first started looking at it. But it's an ancient technique, hundreds of years old, and it's very, very simple to follow. And obviously, questions. If you don't understand anything, that's usually I haven't explained it very well. So email me, as I say, at webinars@hotforex.com if you're reading this or you're watching this video after the recording. And if not, put it in the question box as we go through today. Okay, good stuff. So let's get going, let's get interactive. So very basic, some 4 key points about candlesticks, which hopefully we'll all know whether we've been trading for a few days or a few years. The candlestick, the Japanese candlestick, shows you much more information than a simple line chart or indeed even a simple bar chart. There's a lot of detail on there, and it's the graphics of it I really like. The candlestick is the most common form of chart used by traders today. We all know it, we all love it, we all use it, or most of us do. Others, obviously some people don't, not everybody does, but it's a very great and clear way of establishing what's going on. Importantly, candlesticks represent the time that the candle takes to form, which is referred to as the time frame. I'll cover this now, but I will repeat it again as we go through. It's really important that you wait, whatever time frame you're trading on, you wait till the candle's complete before you make your decision. So if you're trading on a 1 minute candle or a 5 minute candle, you need to wait to the end of that candle before you make your decision. Don't jump in halfway through. And it's even more important when you're trading the higher time frames. 4 hour time frame, it can take, obviously it takes 4 hours to complete. And if you're looking at that candle after, it's the first 10 minutes of the 4 hours, you've got a long way to wait, and the candle can change its implication, its pattern, its predictions during that 4 hour, so it's very, very important that you wait till the candle's complete and only make a decision on the completion of the candle. So that's why it's important to decide on the time frames that you're trading and never jump in too early. Anyway, I'll talk about that more later. Candlesticks, or Japanese candlestick trading, became very, very popular in the West following the publication of Steve Nison's book, The Japanese Candlestick Charting Techniques, back in the early 90s. Steve Nison, he runs his own website. I think it's called Trading Candles or Candlesticks.com. Google his name and you'll see his books and his websites. But he's in America and in Europe, he's seen as like the father of Japanese candlestick charting techniques, and he runs workshops and runs his own website, and you can subscribe to that if you like. And yeah, he's a good guy, he's a good teacher, and he's a big passionate follower of candlesticks, and his teachings popularized them here in the West. Okay, so very basically, here we've got 2 type of candles look the same. The orange is a bearish candle that's going down. The blue one is a bullish candle going up. So each candle shows the open, close, high, and the low. It's simple as that. I'm sure you all know that. You've been trading it before. So what we've got here, we've got the opening price over the period of the time frame, and during that time, from the time it opened here, it got as high as the price got as high as this point, as low as this point. But when this time frame was complete, the price closed here. So we opened here, got as high as here and as low as here, or as low as here and as high as here, we don't know. And it closed here, but we do know it's closed at this point because it's orange and we're going down, so it's a bearish candle. Okay, this slide just shows bearish and bullish candles in orange and blue. Normally on my MT4 platform, many MT4 platforms, it's red and green. Others use green and black. It's up to you, it's personal preference, but it's just showing the same thing. Colours is a personal preference. And obviously the bullish candle, the price opens here, it closed here in the time frame, whether this is a month or a 5 minute candle, doesn't matter, because it opened here, closed here. We do know the price got as high as here. We also know that the price got as low as here in this time frame. Okay, they're the 4 facts that we know. How quickly it formed these positions, we don't know, but that's what the graphic is showing us, and that's why candles are so easy to trade with, because it's very clear, a quick look what's going on. So there's the candles in a nutshell, and I'm sure a lot of you have obviously seen these before. So like I said a few minutes ago, it's really important now that you finish, or you let the appropriate time frame complete. Because here is a good example. We've got 20 minutes elapsed here, around here, and on the 5-minute time frame we have, obviously we've got 5 times 4 is 20 minutes. We got 4 completed candles. I know at the beginning of the 20 minutes the price is opened here. At the end of the 20 minutes the price is closed here. It's been as high as here, and it's been as low as this point. Yes, so we've got that depicted in 4 candles. With a 15-minute time frame candle, we only have 2 candles, don't we? We have the completed 15 minutes, so the first 15 minutes from here to here created this candle, which is engulfing, if you like, or taking up the first 3 candles we've got here, 5, 10, 15 minutes. So those 3 candles are depicted in this one candle. But the next 15-minute candle hasn't completed. We're only 1/3 of the way through the next 15-minute candle formation. And at the moment, this 15-minute candle looks exactly the same as that 5-minute candle, doesn't it? Because we're only 5 minutes into the 15-minute candle. So, same bits of information depicted in 2 different ways on 2 different time frames. And that's why it's important to make sure that you let the time frame complete before you decide whether you're going to buy or going to sell, or you're going to interpret the candle formation. Okay, so you shouldn't be using, if you're trading on 15-minute time frames, you shouldn't be looking at the information really on that candle. You should be, this is the one that's complete, and this is the data that's helping you with your analysis. So you shouldn't be looking at this one because it's still not formed. It could end up here, you know, and it would look very, very different, wouldn't it? The low down here, wick up here, or the body up here. So it's very, very important to make sure that the candles are complete. And you know, this is quite a clear example of how the same information can be depicted on 2 different time frames, looking quite different. Okay, well, that's very clear and straightforward. But the beauty of candlesticks, as I said at the beginning, it's all about this visualization. It's a graphic. It looks very clear: the high, the low, the open, the close. And it's a great way of assessing this balance, this constant conflict we have in markets between buyers and sellers. You know, people that want to push the price up and other guys that want to push the price down. And that's all a market is, whether you're buying and selling currency, oranges, apples, bicycles, whatever, bales of hay. You need a market. And so to create a market, you need somebody that's prepared to sell something and somebody that's prepared to buy something at a set price. Shake hands, deal done, off you go. Both sides should be happy because they've both got what they wanted. And that's all a market is, buyers and sellers. And a candlestick shows us that. It's a great way of giving us momentum, because the longer the body of the candlestick, the more momentum there is in that particular direction. And that's what we're looking for as traders. We want momentum, we want volatility, we want things to be moving, because then we can jump on the back of the movement and grab a few pips on the way up or the way down. So momentum's great, and volatility is great, and candle patterns are great for showing that very quickly with a quick eyeball at a particular chart. So it means to us as traders that the longer a bullish candlestick is, you know, those ones we were looking before, the blue one, the more buying pressure there is in comparison to selling pressure. So therefore the price is going to go up because there's more buyers and sellers. And conversely, the opposite is true as well. The longer a bearish candle or orange candle or red candle or whatever colour your candlestick is, the more the selling pressure is in comparison to the buying pressure for that particular period. So again, it's all about momentum, volatility. The candle predicts that, or doesn't predict that, sorry, the candle presents that for you in a nice, simple, graphic way. You put a few candles together and you know, you might have yourself a trend. Off we go. Okay, nice and easy. So let's take an example from last week. If those of you that were here last Tuesday, when we did our live analysis, this is a pair we talked about. We had a great Tuesday last Tuesday. We talked about 5 pairs, all of them triggered, all of them hit target. 3 of them were already in play during the during the webinar, and the £2 ones triggered after the webinar. But this was me taking a broad view on the daily chart, looking at the candle patterns, looking at what would happen. So last Tuesday when we were talking, this was last Tuesday. This green, yes, this green one here. This is why I've got this purple at 172.50. It was around about this level, and what I said last Tuesday, you can go and listen to the webinar if you like, but I'll repeat it here. Is that we had this, the pound had the shock of Brexit against the Aussie dollar. This one, we'd had 8 days down, 1, 2, 3, 4, 5, 6, 7, 8 big steps down, and it got all the way down to 1.711 and seemed to have formed a 4. The following day, on the Monday, it did exactly the same thing. It spiked a bit lower but couldn't get much lower. So two quite strong bottom, or a quite strong bottom there after these consecutive movements down, these candles getting bigger or consistently getting, and this bigger one here as we're coming down. So we've had this 1, 2, 3, 4, 5, 6 days without a breather. We had a breather on the 7th day, but the 8th day we went down again, and then perhaps we formed a floor, and then the 9th day we seemed to tick up, and that's what caught my interest on the Monday evening. And I saw this key figure. It's a round figure again, a round number, 172.50. You'd be amazed at how many times markets gravitate to these round numbers, zeros and fives, all the time. So at the time we were saying what I was looking for then was this pair, because at the time obviously we don't know where it's going to finish for the day. We wanted it to finish above this key level, this level we'd identified. This was our support, or our stop level if you like, and we were wanting to catch a bit of this bounce. It moved down consecutively for 6 days, so we were looking for like half at least of that sort of return to get the trade, the bounce back up. And that's what happened. We got in just before the close on the Tuesday evening at 13.60, I think it was 173.60. I can't remember the exact. Oh, here we are. Yes, on the 12th at 173.60, and that bounce did occur. Obviously, on we had to wait a few days, but that's part of patience, part of trading. Especially when you're trading daily candles, we had a good rally up on the first at one point during the Wednesday, but Wednesday closed down. We got even lower on the Thursday, but our position was down here, and we finished Thursday, and then Friday finally. I think Thursday got very, very close to this 176.10, our target level here, the top of this candle here. But it was Friday when we closed out at 176.50, so that's 250 pips in a few days on that pound retrace on the Aussie dollar, and a lot of that was based on just the candle patterns, this formation that it doesn't go on for nothing goes on in one direction forever. There's a turn, and we had a turn and a bounce, and I don't know where we are now. We might have come back down here, we might go up here, but for us didn't matter. We caught the bottom, caught a little bit of the retrace, and away you go. And that's keep it simple, and that's exactly what I teach and we talk about all the time, and that was a successful one. If it hadn't have worked out, so what? It doesn't matter. Got good risk management. We move on to the next one. So that's how candles can easily. That particular one really jumped off the page at me, just because we had these consistent steppings down. And later we'll talk about the power of 3 in Japanese candlesticks as well. And if you'd caught that earlier, you could have seen that was a clear movement down, and I'm sure a lot of people did. They probably got in here as a short and took it down to the bottom as well. I didn't see that particularly, but we'll talk about the power of 3 and the different patterns that the multiple candle patterns form as well. Okay, so it's just an example. So the other thing with candles is we have the body, which is the main part, and the wicks, the extensions, the shadows, as sometimes they're called, of how far the price has got, either high or low, during the time frame. So interpreting the size of the candlestick wicks, obviously this one here on the right hand side is a fairly bullish candle. Now how do I know that's a bullish candle? Well, we know it's, it's blue because we know it's opened here and closed here. Well, what makes it bullish? It's got a long wick at the bottom and hardly any wick at the top. Okay, so during the time frame of this candle forming, the bears attempted, so the sellers, the bears were trying to push the price down to here, but it got here, but it ran out of energy. It didn't get, it got down and got down, it got as far as here, but eventually the balance shifted back towards the bulls, and the buyers pushed the price back up over the opening price, and it actually closed higher. The candle ended up closing as a bullish candle past the open price and closing up here for the day, and it even got a little bit higher. How it did that, we don't know, or the time how that was formed, but we do know that it's opened here, it's closed here, got as high as here and as low as here, so that's suggesting a very, very strong bullish sort of candle. When you see candles like that, I'll talk about more of those in a minute. But again, it's like I said at the beginning, always wait for the candle to complete before you make your decision, because halfway through this candle formation, whether this was you're waiting just for 30 seconds as a scalper, or you're waiting for a week or a month as a long-term trader, you've got to wait for these candles to finish, because you get a very different interpretation during the formation of a candle like this than you would at its conclusion when it's finished like this. Okay, I hope that makes sense. Patience, discipline, two good attributes of successful traders. So we lots of names in the world of Japanese candlesticks. One of the most popular, one that you see all the time, is doji, the doji candlestick. And this is the one, not that we don't want to see, but it's the one that it's part of, it's part of the Japanese culture, it's part of the Japanese society. It's all this idea of balance and equilibrium, and from traders we call it indecision. So the doji candlestick is a pattern in which the opening and closing price are the same, or very, very close to being the same, as this image here on the right hand side shows. So here it's blue, so we've opened up we've closed a little bit higher than we opened. So we've opened here, we've closed here, and in the meantime we've got as low as here and as high as here, but we're in decision. The buyers and sellers are in balance or in equilibrium. So indecision prevails, and as traders we don't really want that, do we? We want certainly as trend traders we want to see a movement in one direction. But sometimes the dojis can give us that tipping point, that balance point. So if you see a few dojis, it could be an anticipation of a change in direction, suddenly going in another direction, or indeed a market going sideways. So as a trend trader you would perhaps stay away from that, but as a sideways somebody that trades the channels, that might be something you'd be looking for as well, this balance point. But indecision, equilibrium, balance, that's what the doji candles show us. There's 4 typically different types of doji candles you may see. This is the classic star doji. They have different names depending on where the balance point is. Sometimes the balance might be down here, sometimes the balance might be up here, and there's typically 4 names of the doji candles. I won't go into them here, and if you want to know them all you can go off and say if you Google the names. There's lots of stuff out on the internet, lots of stuff on YouTube, and I say lots of books on candlesticks. Now I'm not going to endeavour to cover them all here, and I wouldn't insult you all by trying to cover every single candlestick pattern. I'm just going to go through the main ones that I use and that have helped me in the past. Okay, so doji, the balance, equilibrium, indecision. Jump off again. Nice clear, isn't it? It's easy to see that. That'll jump off a chart at you, wouldn't it? A skinny body. No body on the candle, just the big tall wick and the shadows at the top and bottom. Very, very thin body, or non-existent body whatsoever sometimes. So, as I say, there's many candlestick names. I'm not going to run through them all, but I will run through 3 principal types. The single candles, which again many people trade off. I don't. I like to see a bit more information, but I know many traders that just simply wait for certain types of candles, and that's enough information for them to trigger their trading approach. Whether they're trading, short time scalpers or they're longer term swing traders or position traders, excuse me. So they all have names. You don't need to remember them all, but let me just, for the benefit of a lesson, let me just run through them all here, okay? So, 6 key single candle type patterns. They all look the same, but they can mean the opposite, or they do mean the opposite, okay? So a Yo-Sen candle is bullish, and an In-Sen candle is bearish. They both look the same. They both have big long bodies and very short or no wicks at the top and bottom of their candles. We'll bring up some patterns in a minute. I'm just going to run through the words at the moment, okay? So just bear with me. So as we run through these 6 types. The hammer candle or bullish is a bullish formation, and a hanging man is a bearish formation. And again, graphically they look the same, but they're at different points in the chart. They have a very small body and a very large wick below the body. Okay, so hence you've got this hammer shape, or what some people unfortunately call a hanging man, where they've got the small body at the top and a long wick or body below it. Okay, sorry, long wick below it, not so small body, long wick, but below. The opposite of that is the inverted hammer, which is a bullish signal, and the shooting star candle, which is a bearish signal, which has a small body, but the large wick is above. And for these to be significant, these single candle patterns, or these single candles, the wick in on all 4 of these candles, for them to become a hanging man or a shooting star or an inverted hammer, the wick needs to be 2 to 3 times the length of the body. The longer the wick, either above or below, the more significant the potential move could be. And again, you'll see that on some charts I'm going to bring up in a minute. Okay, so single candle candlesticks can help you predict when prices may be about to reverse or indeed continue, depending on what the preceding pattern is. Okay, there's a lot of words there very shortly, so I apologize. Let's look at some pictures and try and explain what I've just said. So 6 key candle patterns: Yo-Sen, In-Sen, hammer, hanging man, inverted hammer, and shooting star. They look the same and they mean the exact opposite of each other. Okay, bullish or bearish depending on the pattern style. And again, I say there's many people trade off these single candle patterns, but not me. I like to have a bit more information. So single candles look the same, mean the opposite. So Yo-Sen, bullish. Here we got a big up candle, shortish wicks compared to the size of the candle body, very bullish, and indeed, well, it was quite bullish, wasn't it? Because it was coming to the end. We only had 2 more up days before it rolled over. Anyway, that's an example. Here we got the similar one, another one up, but we had a lot of volatility, but that was the famous Brexit day. So here continued up for a few times, here continued up for a few days thereafter. So these Yo-Sen candles, lots of long bodies, small wicks. If they're green, they're bullish, they're going up, and the opposite in an uptrend. Again, the candle patterns are very good in trending markets. If you've got a very good trending market, these candle patterns tend to be very, very significant. This particular chart here, this Aussie CAD, we'll come back to later. This is actually a trade we've got running at the moment, and there's another candle pattern here which we'll talk about in a little while as well, but we'll see this chart again later on today. So the opposite of the Yo-Sen is the In-Sen, which is a bearish signal, and again a big strong candle with very little wick. So here we got the orange for down here, blue for up. So we got down and it continued down. Another big one here, small wick, no wick at the top here, no wick at the top here. Big significant move down. Look at that, all the way down there, and off we go. So some people just monitor these single candle patterns in this formation, continuing in this direction here. So this might have been an up run, it might have been a sideways, but a big step down, a big break from this level, and off we go. This is an hour chart. So Yo-Sen single positive, In-Sen bearish, single candle. Okay. So next two are the hammer and hanging man. Again, One bullish, one bearish. Small body, large wick below, 2 or 3 times larger than the body. So here we've had a downtrend, 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 and the hanging man, sorry, the hammer candle here is signifying a potential end to that movement down, because we've had the price continually going down. We've got continual lower lows, a very strong trend down here, and we're running out of energy by the looks of things. So we've got this big, look how long that tail is compared to the size of the body. Very, very long tail, very significant factor. It's easy to look at it now and say, well, that was clearly looks like the bottom, doesn't it? Because we can see all these. Remember, as a trader, we don't see anything to the right of our screen. This would all be blank. You know, at this position, where are we on now? 23rd of January at 3:30. Sorry, 1300. We're looking. We need to know what's going on here. All of this that happened behind us is helpful, but it's what's going forward helps us make trading decisions. So it looks, I say, these examples in hindsight look great, but remember, we're trading on live charts at the live end of and that's the decision you've got to make. But if you'd been watching this trend, 15 minutes over the last few hours, it's come down overnight here. It's an overnight session. Early morning here, looks like it's London opening time 7:30. So we've had enough of this downtrend. London wants to buy the euro yen, and off we go. And the first big significance of a bullish move up was our hammer candle here, our bottom of the market here, as off we go. Okay, the hanging man looks the same as the hammer, but it's at the top of an uptrend, so it's signifying the top or the peak, or we're running out of buyers. We can't get any higher. There's no more buyers coming in. The sellers are starting to take over, and the sellers have tried to move it down, but they couldn't move it any further down. It's come back, but it's finished lower than when we opened. So this was our last big buying in this uptrend. So here we've got 1, 2, 3, 4 here. These are only minute candles, but again the principle's the same, remember. And that's the beauty of technical analysis. You can apply it to minute, 1 month, 1 week, 15 minute, whatever your time frame is. The patterns are the same. So here we've got last 5, 6 minutes, 10 minutes. We've got this movement up, running out of energy, signified by this one. This one might have gone up again at inverted hammer. But anyway, we're at the end of this up run, and signifies that we're rolling over. So, and indeed we did. The hanging man gives us the bearish signal to sell around at this point, or perhaps at next minute here. So that's the trouble with short time frames. It's can be quite difficult to get in. Okay, so patterns. It's all about the patterns. Single candle patterns. That's two of the 6 we wanted to look at. The last 2 are the inverted hammer and the shooting star. Like the hammer, but the other way around. They look the same. We have a inverted hammer, which is bullish, end of a downtrend. The wick 2 to 3 times bigger than the body, running out of energy. We can't get no more buyers, sellers in this market. The buys have ticked in, so we bottomed out here, signified by the next candle. 5 minutes later, 10 minutes later, we're all the way back up here. So if we missed the move, well, I don't know, because this might be insignificant, but we still went off up for the next hour or so. Okay, so inverted hammer looks the same as a shooting star, but it's the other way at the end of a downtrend, whereas a shooting star tends to be at the end of an uptrend. And here we've got a couple here in a row. We come down at a little bit of retention, respite. And here, this is a good example of waiting till the handle's complete. Because this was taken from this morning, or yesterday, 19th, yes, this morning, and this one looks like a hammer candle, but it isn't complete. So the snapshot was taken before this one was complete. So this isn't showing us these 2 have given us this shooting star. The wick 2 to 3 times bigger than the body of the candle, and then we got another one. These 2 here. We got this one here, which is just as strong, if not stronger, because the body's much smaller than this one. So we've already rolled over a bit of resistance, and looks like we're going to go off on down against the dollar CAD there on this particular 15-minute time frame. Okay, so we could go possibly down to here. So inverted hammer, shooting star, that 5 and 6 of our single candle patterns I wanted to show you today. One bullish, the inverted hammer, one bearish, the shooting star, and seen at the top of an uptrend, and as the buyers run out and we're off rolling down, the sellers take control or take over. Okay, so there's lots and lots of other candle patterns. I'll run through a few more. They're the principal 6 single candle patterns. As I say, people do trade off those single candle patterns. Obviously, the more information you have, the more comfortable or more confident you might feel in your decision making. So next ones we're going to look at, we'll look at tweezer tops and tweezer bottoms, double candle patterns, if you like, or 2 candle patterns. Engulfing is a 2 candle pattern. Then we'll look at this idea of 3 and the significance of 3 in the Japanese culture, and how that fits in. And we look at black crows and soldiers and evening and morning stars, which will look very familiar to anybody who's been on any of our other webinars in the past. Okay, so as I mentioned earlier, we were looking at a chart of the Aussie Canadian of a trade that we took earlier today, or last week, and this was helped with one pattern we're just going to talk about now, the tweezer top and tweezer bottom. This is a 2-pair candle, so similar size. To create a tweezer top or a tweezer bottom, you have similar size candles. Most important bit is that the wicks are a similar high or similar low, so they appear like a pair of tweezers sticking out of the candle patterns. And for a tweezer top, we want for tweezer top or tweezer bottom, we want one candle to be bullish and the second one to be bearish. And for a top, the best way around is that the bullish candle comes first and then the bearish candle comes after. Okay, that's the rule. So here we've got this uptrend and we've rolled over the trend, tried to get higher. We've gone higher, we've closed higher than we opened, got a bit higher, we couldn't get as high. We opened here, we went a little bit higher again, but we couldn't hold that high, and we ended up at the end of this period, it's this day, we ended up down. So we created this tweezer top, and that's what got me interested when I took this trade last Thursday. I think it was the 14th was Thursday, wasn't it? Or was it Friday on Saturday? I think it's Friday we opened this particular position. So we identified this tweezer top on earlier in the week, the Monday, Tuesday, Wednesday, Thursday. It'd come back to this line I'd put in long time ago. It's not very clear from this chart, but that was a line, a trend line it had broken, and we got filled on this position here. I think it was supposed to be at the end of that day, but anyway, we were filled at this price here, and subsequently last few days it has indeed rolled over, and it looks like we may be heading down. We may have got maybe one of those trades that gets very, very close but doesn't actually hit the target, but that's sort of where we are with this one. And that was the pattern there, was the tweezer top, because it had this long uptrend through the Brexit, Aussie getting strong, Canadian getting weak as the oil price rolled over as well. Gold improved as the rush to a safe haven. Aussie is very, very closely aligned to the gold price. And then we got this tweezer top. That was interesting, I thought. We're out the top of the Bollinger Bands, rolling over above this 20-day moving average, and our take profit is down here at this 20-day moving average, and the very strong purple line is the 200-day moving average. It's a very, very strong moving average. So as you see, when it broke up through there, it hasn't managed to hold up above it, so it looks like it may be coming back down there, but that's close enough for me, because that will provide some resistance. We've got these two moving averages here and the 50 here, so they're out of a line, which is not great either. So it's good for a further weakness potentially on this pair. But principally it was the tweezer top candle formation that got me interested in, and I used some other indicators and other analysis to sort of add to the weight of taking the trade. So that's a trade that's open at the moment. So tweezer top, a 2 candle pattern, and at the bottom, I don't think I've got an example of a tweezer bottom, unfortunately, but a tweezer bottom is the other way around. You get the bearish candle first because we're in a downtrend, and then you get the following bullish candle. This is the bottom of the trend, so you'll get the red one and then the green one. The wicks at a similar point. They don't have to be exact, obviously. There are a few pips between them. It's just giving the impression of a pair of tweezers, and that's sometimes signifying the end of an up run or the end of a down run. So tweezer tops and tweezer bottom, two candle patterns which are very, very, again, quite easy to spot because they're side by side like soldiers stood up right, but the wicks make them look like tweezers. Okay, so I say that's a trade that we've got open at the moment based on that tweezer top pattern. Next double pair is very popular and very powerful. This is called the engulfing. The engulfing pattern is a strong reversal pattern. It can either be bullish or bearish and composed again of two candles. So it's a two candle pattern, and sometimes other candles come in to support the evidence. The key thing with engulfing is that the body, not necessarily the wick as well, but the body of the second candle must be engulfed, taken up by the body of the preceding body. Okay, does that make sense? I hope that makes sense. So the body of the second candle must be engulfed by the body of the preceding body of candle. Okay, so at the end, again, very useful in strong trending markets to mark the end of trends, or a reversal in trend. So here we've got a bearish engulfing where the second, so we've got these up candles again over a period of time. This is a 5-minute chart on the euro dollar. 1, 2, 3, 4, 5. So we've got, half an hour, 30 minutes, 40, 45 minutes of uptrend here in the euro dollar. And then finally we get this second candle engulfing all of the first candle in the downtrend. So we've got a bullish candle followed by a bearish candle again. Not a tweezer top because they're a bit too far away, but close-ish, isn't it? So that's a bit of evidence. The second candle engulfing all of this first candle, and it was bearish, so off we came. That's the bearish significance of that one. Okay, the bullish engulfing is the same way, but it's the end of a downtrend and a change in reversal again. Remember, it's a strong reversal signal. We're going to change direction. So here we've got the second candle bullish, following the first candle, or first few candles here, bearish. You can see that's actually engulfed that one as well. Not all the wick, but there's certainly the body of the second one here has taken up all of the body of the first one. So we've got the end of this big downtrend. So we've been going down, and a big dip, big step down in this last hour hasn't been able to be held for the next and so it hung around for a few hours after the move down, and after 4 hours we were back to where we, halfway back to that previous big step down. So the trend had reversed, signified by this big bullish engulfing pattern of these two candles here, and then off we went back, broke above the big step down, and we were back up and actually higher than when we'd started a few days before. Okay, as we run into at the end of November, as this particular one was. Okay, so that's another double candle pattern. Engulfing, you see them all the time. You see them in many textbooks as well, on many websites as well. Engulfing, both bearish and bullish engulfing, a two candle pattern technique. Excuse me. So next on we go. So next ones we'll look at briefly are the three candle patterns, or this is the last pattern. So we looked at single candles that many people trade off, double candle patterns, the tweezers and the engulfing, and finally we got the three candle pattern. 3 in Japanese society is quite significant. Ironically, not as significant as 4. 4 is a really unlucky number in Japanese culture and Japanese society. As I say, the candlesticks for trading, and trading is deeply enrooted in Japanese culture, whether that's trading forex as they do recently, or trading full stop as an island nation quite isolated from the Western world, close to its big partner China. Lots of trading over the centuries, and 3 is a significant factor in the Japanese psyche, in the Japanese culture, because they're very appreciative of their environment and where they are in the world. Japan, they suffer from 3 major natural disasters: typhoons, volcanoes, and earthquakes. Hit all of the Japanese society, and it's formed the Japanese are over the centuries, and so 3 is a significant in their society, and it's also significant in these trading patterns we see in candlesticks. So a classic 3 candle pattern is something they call stars: morning stars and evening stars. And again, if any of you have been on any of our webinars, you've listened to Jan in the past, or you've seen any of our multiple time frame trading webinars, you'll see that we have something we call pivot high and pivot lows, and these can be very easily interpreted as morning and evening stars as well. A 3 candle pattern signifying a change in direction, and that's what we're looking for as traders, a change in direction. So the pivot high or the evening star, we tend to have a bullish up movement, a small, typically, not always, but a small body, possibly a doji candle, significant the end of the run, the exhaustion of the buyers, and then a bearish candle afterwards, finishing lower than our previous high. Tried to get a bit higher, run out of energy, we ended up down here. So the up run has ended, next candle forms, and it's lower than the previous one, so our lows are getting lower now. The highs are below this peak, this pivot high as we call it, or an evening star, the top of the trend. So we've rolled over and we've created this pivot high, or something we identify as an evening star with this big long wick signifying the end of the run up, supported by the rollover to the other side. And equally, the morning star is simply the reverse of that. Okay, so we're in a bearish downtrend, we're going down. Third candle actually finishes a bit higher than the where we opened, so we've actually bounced up. The wick has moved us down as far as we go. The buyers came back in, there's no more sellers. We've flipped over to more buyers, demand's increased, and the next candle shows that we opened a bit lower, but the energy wasn't enough to take us lower than this point, and we actually ended up higher. And so the 5th candle shows that we're back up, so we've got this bearish movement changing to bullish, possibly a doji candle. I wouldn't say that's a doji candle, but sometimes you do get these dojis of indecision at the top of this movement or bottom of this movement in this case. Sellers running out, buyers coming back in, we're flipping back to an up position, so our lows are higher than our bottom, and so we've got this pivot bottom, pivot low, or morning stars we call it in our 3. If we just looked at the 3 candle patterns, the pivot gives us these extra candles, gives extra confidence before we take the position, but the pivot low or the morning star has been formed there. So we talk about that a lot. Sorry, let me just go back to previous slide. We talk about our pivot lows and pivot highs a lot in our multi-time frame analysis, and that's why I've stolen this slide from you. So here's this multi-time frame analysis, and it's part of the way we trade here at or the way we show you to trade here at Hot Forex. Another, the 2 final 3 candle patterns I'd like to show you today before I bore you completely to death, is the 3 white soldiers, or the 3 soldiers, the 3 advancing soldiers, which is a bullish formation, and the 3 black crows. Again, the significance of 3 in Japanese culture. The 3 black crows, which is a bearish formation, tends to be at the end of trends. Tends to be similar sized candles signifying at the start of a new movement. So here we have the 3 candles, strong candles here. You remember we talked about at the beginning, we talked about the single big candle with very little wick, or top and bottom one. So it is with these, for these patterns to be formed, 3 consistent, very small wicks on these ones. There is another candle pattern called the Mazubu, and many people, when they're looking for these 3 candle pattern repetitions, get too sucked in and they wait for the candles that have no wicks whatsoever, and they're very, very few and far between. So a Mabuzo, sorry, a candlestick that only has a body and no wicks, they very, very rarely occur. So, you know, just take it with a pinch of salt. All of this we talked to you about, you know, they're good in trending markets, they're not so good in non-trending markets. They're great visual indicators, but none of it's 100%. You know, you've always got to trade bearing comfortably and calmly with good risk management, and just take everything and analyze it all. That's why, you know, in my view, you know, banks still pay millions of dollars for good traders. They don't rely on these automatic robots completely. Taking the trades, analysing the trades, yes, you know, robots can be quite good at doing the maths and the algorithms, but actually adding a bit of nous to it at the moment, it's still the human brain that's got the edge. But I'm sure, you know, next 20 years, probably not even that long, perhaps the robots will take over. But at the moment, nothing's really changed over the last 150 years of trading. I'll talk about that a bit more in a minute as well. But anyway, I digress. So 3 white soldiers, 3 consecutive upward candles stepping up, significant strong movement up. Just like we had 3 down here, strong movement down, but it ran out of steam, perhaps because the wicks were too long on these 3. So we've a bit of congestion before we got this clear step up, and off we went here. Again, the daily candle frame. So the 3 white soldiers, or the 3 advancing soldiers, look like marching up the hill, dump, 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 and off we go. That's why it's bullish. The black crows coming down, sinking out of the sky like black crows. Again, strong consecutive downward candles, very low wicks, strong bodies, big bodies, significant movement down. So bang, 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 3 down, bit of congestion, and off we went down again. Bit of a retrace, some long wicks, and off we go again. So signifying the beginning of a new trend, or a significant trend. So how long you stayed in that is obviously up to you. But that's again, these are daily patterns, and obviously the higher the time frame, the more significant these candle patterns can be over the longer time frame. Okay, so big move there from this pattern. If you got in here at 130. What was this, 134.87? We're all the way, you know, it ran out all the way down. Whether you would have stayed in that long from November through to January over the Christmas period, well, maybe some people would have done, you know, gone away on holiday or something for the end of the year. And very, very big move, very significant move as we step down quite significantly, all signified by this the 3 black crows here at the beginning of November. Okay, so you know the power of the candlestick. Some people say they only trade on the three candle patterns, but obviously that they occur less frequently, so they're waiting a bit longer. Other people say, as I said at the beginning, trade off the single candlesticks. That's a bit riskier because sometimes you haven't got a lot more information to deal with. Others trade off the twins, the 2 candle patterns, and obviously many, like myself, combine the best to try and to make the best decisions, and use other indicators and a bit of fundamental information to make their own trading decisions. And indeed, that's what it's all about. Okay, so in summary, there's 5 key things. This might sound a bit confusing, but this final slide, bear with me, it summarizes all these different candle patterns we've talked about today. So singles, doubles, and triples. 5 key things. If you want to write one slide down or look at one side, this is probably quite a good one. So the length of wicks and candles is important. The ratio between bullish and bearish wicks is important. The position of the body in the candle formation itself is important, whether it's at the top or the bottom. The size of the body, like we've talked about a lot, how deep it is, how long it is, and the ratio between the body and the wicks. So the ratio, number 2, the ratio between the bulls and the bearish wicks is different to the ratio between the body and the wicks. Okay, so it's all similar but different. Okay, these are, so instead of trying to remember all the different names of these candles or the different formations and waiting for them to form, if you take a little bit of a step back, it may become a bit clearer. So I'll just run through these Next few slides, quite quickly. So I've been talking for nearly an hour now. The length of wicks and candles. The length of wicks and candles can give you direct information about the volatility, and that's what it's all about. Remember we said at the beginning, volatility, momentum, that's what we want as traders. And sometimes even the doji candles, this balance can help us say, well, we're in a tipping point here, we're going one way or the other perhaps. So the length of the wicks and candles is important, and also the ratio between the bullish and the bearish wicks, whether it's bigger at the top or bigger at the bottom. So when price moves down and gets pushed back, like we saw on a hammer candle, it leaves a long wick to the downside. That can signal that bearish strength is not enough to keep the prices moving down anymore. We might be going back up. Okay, so the position of the body within the spread of the wicks. Does the candle have a long wick to the downside, and is the body at the top of the candle? This can signal great strength. A body in the middle of the candle, by contrast, does not have the candle long wicks to both sides, and it's the position in the middle of the candle, giving this indecision and this balance that the buyers and the sellers, the bulls and the bears, are in harmony. So the position of the body is very important. The size of the body as well. Remember what we said right at the beginning. The general rule of thumb is that the larger the body, the stronger the signal it provides. A large body indicates that price has moved a great distance between the opening and the closing of the candle. So there's a lot of momentum there again. So again, candles are great for providing that as a great graphic, a great visual of momentum and volatility, which is what we need as traders. And finally, number 5, the ratio. So the ratio between the body and the wicks. Is the body of the candle large, whereas the wick is small? It shows that price has moved from the open to the close without much volatility either side. Small wicks and a large body are a sign of strength. Remember, we've got this strength in the size of the candle again. In contrast, long wicks and small bodies indicates this idea of indecision again. Okay, so in summary, if you didn't want to learn the numbers, it's just this visual implication. Okay, so a large body, small wick, great strength, whether we're going up or down. A long wick and a body near the other end of the candle show that momentum has shifted from one way to the other. So here we've got our shooting star candle. Here we've got our hammer candle, where we've got a long wick to the bottom. The wick 2 to 3 times bigger than the body. That's quite important as well. The longer the wick, either above or below, the more significant the signal can be. And in summary, or in balance, this doji style, where the wicks to both sides, the body in the middle, indicate indecision and equal powers, buyers and sellers, bulls and bears, in some sort of balance. Large wick, small body, more and more indecision. If the closer to the center, the more indecision there is. So these star dojis, I said before, are probably the most indecisive of all as far as the market is concerned. But as traders, they're interesting for us because it's showing nobody's in charge. We don't know where we're going. We're not going higher, we're not going lower. So what happens? Well, nothing. We sit on our hands, we wait and see. Part of being a great trader is not to trade. Knowing when not to trade. Sit on your money, because again, 90% of being a great trader is capital protection, looking after your account and looking after the money that you've invested. And not trading is really part of trading. And I talk about that quite a lot in another webinar as well. But that's an art in itself as well. Okay, so I hope this has been useful. That's the basic introduction to candlesticks, singles, doubles, and trebles, or three styles. Very simple to interpret. This is a trade. I did a post on, I think, Monday or Friday about this. This was one of my sort of gut reaction trades, which didn't really have a great deal of technical backup to it, but it was just I felt from something called the VIX, which I'll talk about another day. The stock markets for me are looking very, very rich and very, very overbought. But anyway, this is just an example of, you can see lots of the different candle patterns we've talked about here. Gaps here on indices, you tend to get that sometimes on indices, and stocks, you very, very rarely get gaps on forex. In the forex market, obviously occasionally it happens, but where the closing price one day is much higher than or lower than the the opening price the next day. That's what all gaps are on markets. So anyway, so we've got these three after post-Brexit, these 3 consecutive candles. Wicks are a bit large to call them soldiers, but it added strength to FTSE and the UK 100, and off it went thereafter. Bit of a possible top here, we'll see, and that's, you know, we were in here at 620, and we'll see how this trade plays out. You know, may get stopped, may get taken out, may not, but doesn't matter, because, you know, it's 1%, so that's how we do it. So anyway, it's, you know, candles, great graphical interpretation of presentation of price action, and it can really help you because it keeps it simple, and you can zoom in and zoom out, and different time frames help you with your trading as well. So just before I go, I'll mention, you know, people ask me all the time about the one trading book. This is the one you should buy, and just from a, not necessarily from a technical trading point of view, because again, if the skill is to hang on to your capital and grow your capital, you really do need to know yourself. And this story of Jesse Leverve, the book is called The Reminiscences of a Stock Operator. Over 70 years old now, but it's as true then today as it was then. Jesse Livermore, legendary trader, made and lost a fortune 3 times. He's worth over $100 million in the 1920s. Great anecdotes in the book. Edwin Leverve wrote the book about him. He unfortunately committed suicide because he couldn't come back the 3rd or 4th time. Old Jesse, but fantastic anecdotes. I've read it 2 or 3 times myself. I bought it a long time ago. I always promised myself to read it once a year in my trading career, and I must. I've been saying this for a while now on our webinars. I must pick it up again and start delving into it. But if you just quote Jesse Livermore or The Reminiscences of a Stock Operator, I think Wiley, the publisher, there's all sorts of quotes from him. One of the ones I like is this one here. The only way you get a real education in the market is to invest cash, track your trade, and study your mistakes. And he's full of those nutmegs like that. So anyway, that's, you know, if you want to buy a book on trading, buy that one. There's lots of technical books as well you can buy, but this is all about knowing yourself, and it's a great book. So thank you for your time, guys. Coming up, webinars tomorrow, Thursday. Josh is talking about money management, very important, money and money management. Next Tuesday, the 26th, I've got another live analysis workshop. Do come and join me then and see if we can pick up some trades and see how we trade. I've also, on the 28th, got a session with FX Street at the same time, 11 AM GMT. So I'll be on the FX Street site on next Thursday, the 28th at 11 AM. And then finally on the 28th, Josh has another webinar where he talks about EAs. Not one of my favourite subjects, EAs, but anyway, Josh will be talking about the signs of a bad expert advisor, which will be fascinating. I've not heard him talk about that before, but that'll be interesting. I might have a dip in there and see what he's got to say. I think him and I have a very similar view on EAs, but anyway, that's for another day. So thank you for your time. Any questions, please email us at webinars@forex.com, and we'll get back to you as soon as we can. Thank you for your time. Thank you for listening. It's been an hour of your time. I really do appreciate, and I hope you've learned something today. If you haven't, email me, tell me what's wrong, and tell me how we can improve. If you have, email me and also tell me how we can improve. Okay, all the very best to everybody, and take care. Bye bye now.